Good morning, everyone, and thank you very much for joining. This is the morning market review. It is Tuesday, the 13th of December. My name is Russell Shaw, Senior Market Specialist at FXCM. My email address is rshaw@fxcm.com. I'm just going to bring up our high-risk investment warning. Can I just get everyone to confirm that they can see the screen, see the camera, and can you hear me? Okay, excellent. Excellent. Hey, Howard, morning to you. Excellent. Hey, Lisa, morning to you. Thank you, everyone, for joining this morning. It is much appreciated. I'm just going to bring up now the market commentaries disclaimer. I'll keep this on screen for a few moments. Hey, Derek, morning to you. Nice to have you on the webinar. All right, our references, market scope, trading view. I'm going to use the FXCM calendar, and we'll go through the Bloomberg emails. I'll just bring up the calendar. So I'm going to be using the FXCM calendar. Something that's worth taking a look at. Just news out of the UK, average earnings coming in at forecast. But take a look at the claimant counts. What is a claimant? This is unemployment. Claimant counts, the change of number claiming, it's much higher than forecast. 8,000 was forecast, last month 3.3. We've got a dramatic increase here. Okay. I'm just going to go down. I'm going to go down to this, the core CPI. This is ZA time. So at 3:30, we're going to get the core inflation out. And this is CPI, right? This is the same as 1:30 p.m. UK, okay, because there's two hours difference between us. I want to just draw your attention to the headline here. It's expected to be lower at 7.6. When I say lower, 7.7 is the actual from last month, year on year. It's expecting 7.6. Now, we'll take a look at the median inflation in a moment, but if we get something lower than the 7.6, I think there's going to be a rally. And if we get something sub, now this is a big if, okay, I'm not sure we'll get anything sub 7, but that would be a gigantic rally, okay, one would expect. Let me tag that on. Nevertheless, keep an eye on that. The core inflation we also want to keep an eye on, right? So this is now expected at 6.2, so moderation still expected there. Let's bring up this chart. I'm going to keep this on screen for the time being, and whilst it is on screen, I shall go through the email. Got some interesting news I read this morning. So Sam Bankman-Fried has been arrested. He is the disgraced co-founder of FTX. He was arrested in the Bahamas, and that's after the US government filed a criminal indictment. It's sealed at the moment. They're going to unseal it, I think, later today. So we'll see what the charges are, etc. But he has been arrested. In terms of China and Hong Kong, Hong Kong will remove a ban on international arrivals going to bars or eating at restaurants and stop requiring people to use a health app to enter venues. So that's further news of easing on the lockdown. European Union countries reached a preliminary agreement to clear the way for Ukraine to receive crucial aid from the bloc after Hungary dropped its opposition in exchange for a reduction in penalties over graft concerns. Goldman Sachs aims to cut at least a few hundred more jobs as the Wall Street Titan restructures its struggling consumer business and braces for an uncertain economy in the year ahead. It could eliminate up to 400 positions. Right, coming up, European shares are poised for a muted start as investors remained wary ahead of key US inflation figures. Other expected data includes unemployment in the UK, so we've seen that. The Bank of England releases its financial stability report. So Bank of England also is coming out with its, it's probably going to hike by 50 basis points. Maybe the communication out of the Bank of England is poor. 50 basis points is the consensus. I think there's going to be a split, certainly going to be, it's not going to be unanimous. All right. Let's take a look at this. This is the Dow Jones. I think this is a fascinating chart. This is the daily. You can see how there was an, so ahead of the key inflation and ahead of the key rate hike from the Fed, the Dow Jones has jumped from zone 3 into zone 2. So that's a relative strength movement. It's moved from its position of weakness into its neutral area. That's a step forward, right? So that's, but what's interesting to me is the narrowing of the Bollingers. So you can see the Bollingers have narrowed quite significantly. We have seen an even tighter squeeze before down in April, but so it's squeezed in April, and then we had the expansion of volatility down. Squeezed in July, then we had the expansion of volatility up. Well, it's squeezing again. The problem is, of course, that the Bollinger theory doesn't say much about the direction of the expansion in volatility. I think that it depends very much on this inflation print. If the inflation comes in higher than expected, I think the expansion is to the downside. However, if it comes in softer than expected, well, that's going to prompt the rally, right? If it comes in lower than expected. And the reason for that is because ultimately it's going to impact on monetary policy. And I just wonder if the relative strength movement, the movement from weakness into the neutral area, is some sort of directional bias there. But it does look like we're getting ready for a rally here, or dare I say, capitulation. The Bollinger Bands have squeezed quite tightly, you can see. So that's going to be very interesting indeed, just to see how that plays out. I want to show you guys a few things that I think are very interesting. So this is the first chart that I think is very interesting. The second chart that I think is very interesting is actually the China 50. I want to bring that up for you. And I'm using the China 50 more as an indicator than as a sort of a destination. But let's go through to the monthly chart here. I think we can actually take the Bollingers off here. I wasn't looking at the Bollingers for China. What I was looking at was the COPOC. So let's just bring in the COPOC here. All right, I clicked it too many times. All right, and what we want to do with the COPOC, now that we're looking at this on the monthly, we want to do two things here. We want to add in the 0. So let's just bring in the 0. And I want to just throw in a 3-month exponential moving average as a signal line. Sorry, that's not what I wanted. Let me put this one in. There we go. And this, we can get rid of this. All right. I'm zooming right in here. And you can see the COPOC crossed over its signal line. Okay. Now I think this is I think this could be significant. The China 50 has been you know, really hammered hard through 2021 it started, and it's continued all the way, so from 2021 through to 2022. So for 2 years it's been hammered, not without reason. I think that the lack of transparency, number one. Number two, the China economy has been really feeling the brunt of the last 2 years. There's also been some imposed regulation on technology companies, and by and large, what effectively happened was the risk profile for China increased, and because the risk profile increased, the required rate of return increased, and because the required rate of return increased, the price came down to make provisions for that required rate of return. Well, it looks like the price adjustment has now taken place. In other words, potentially, and this is the key word, potentially, we've fallen far enough that the appreciation can effectively meet the required rate of return. Now, we've got the crossover in the COPAC. Now, again, I said I don't want to necessarily sort of espouse this as a destination, although I would suggest that a lot of fund managers will be looking at this as a destination. What I want to look at it is in terms of an indicator. And this is where it gets, I think, very useful, in that the bad news, so there's bad news coming out of China still, but the market has stopped declining. Well, as soon as a market doesn't decline, even after bad news comes out, well, then that's telling you the bad news is discounted in, okay? And if the bad news is discounted in, well, then the potential for value here must be acknowledged. So what's the bad news? Well, they're opening up, which on face value is good news, of course, but the lack of vaccinations, the lack of herd immunity, I think that there's a real chance of COVID, unfortunately, outbreaking, and I think that's something that we're going to have to watch. But if we sort of take away that sort of human element to it, unfortunately, so we just sort of move from the tragedy of a potential outbreak, as an indicator, it does look quite promising, okay? In that you've got this, it's no longer dropping on bad news, and I think that is important on a global basis. Okay? On a global basis, I think this is telling us that markets, they've had enough now. All the bad news is discounted in. Now, let's take this to the yield curve. Okay, so let's bring in the yield curve now. So this is the US 2s 10s. So I'm making the 10s, the difference between the 10s and the 2s. All right, I just need to take the logarithmic scale off here. And we've got just an absolute, we don't need the COPAC here. Yes. Okay. We've got an inversion here that is incredibly steep. The inversion here is, there's an inversion here as well. I wonder why it is not coming through. Anyway, we've got an inversion here, an inversion. Take a look at the current inversion. How do I know this is an inversion? Well, look how far under zero it is, okay? It is very steep to the downside. It's a pity we don't have the history here. Why? Let's try it as follows. Yeah. Okay, let's try this again. Oh, that's odd. I'm not sure why we're not getting the, anyways, why it would be useful to take a look at this is because I'm going to add the 10s and the 2s underneath this individually. So let's just take a look at the components. Made a mistake there. Hold on for me one moment. That's what's got a new pane. All right. So what tends to happen here? Now this is very subtle, so pay attention here. After these inversions, so the inversions generally are signs of a recession. So I think that all this talk about a recession has merit, but I'm not sure that it means much in terms of us approaching the market. In fact, I think that there's a sense here, sort of a contrarian type of sense that we can apply here. And if you take a look, how does the yield curve resolve? Does it resolve on the short end or the long end? And it resolves on the short end. In other words, the 2-year comes down at a much faster rate than the 10-year, and that's how we get the steepening. In other words, the inversion changes, and we get a positive steepening of the yield curve. And the reason that happens because the 2s come down at a much faster rate. Now listen, this is very, very important. This is where we are here. Okay, it's a very subtle point that we're talking about here. So if you guys are not getting it, you must let me know. But what the key point here is that the 2 years are coming down at a much quicker rate, than the 10 years. Okay, so the adjustment, the re-steepening of the yield curve is taking place on the short end of the curve. Now, the question is, how does that happen? Okay, so it's all very well that we say, okay, so the adjustments on the 2-year, but the question is, well, how is that happening? How is the 2-year doing the heavy lifting so that the yield curve re-steepens? Okay, does everyone get that question? And the answer to that is we're going to throw in the next curve, and that's the Fed funds rate. It's monetary policy. Okay, so now what are the implications here? See, here's the steepening. See that? Here's the steepening. Okay. Now this is where we are. What I'm proposing is that if we get a CPI that is showing signs of moderation, and we want to look specifically at the median, okay? When I look at the median, well, then we probably are closer to the terminal value or the terminal rate. In other words, we're probably very close to the end of the current hiking. And if we get the turnaround and we get the Fed funds rate coming down on a fairly fast pace, well, that's what the 2-year adjustment is taking place. In other words, it's going to be a looser monetary policy, which potentially, I've used potentially a lot this webinar, it's going to become a steeper curve because of the monetary policy. Well, that's fantastic, okay, for us as traders, because that gives us a certain direction for sure. If the real rates come down, we've been looking at real rates for months now. If that real rate comes down, then we probably see headwinds for the US dollar. We probably see tailwinds for the Nasdaq and risk assets. So all of a sudden, okay, we're in a market that has an incredible amount of direction when it had a certain lack of direction previously. So we're almost at a point here where we can start saying, is this a turning point? Are we at the low? Now, let's just take a look at one more chart, and then we'll look to conclude, and that is going to be the US median. And the median is a representation of all the sticky items, the items that are not adjusting, but it's starting to moderate. So this is the key. Are we at the apex here? Okay, this is the big question mark. I'm going to keep this question mark and I can't take it out, because if we get a miss to the upside and this median spikes up, that's going to be quite disastrous for the risk markets. But if we are at a turning point here, and this is a parabola, and this is just the first half of the parabola, and if we start to see it coming down, well, then everything's starting to fit together. The puzzle's starting to fit together. Then, of course, the 2-year yield probably does start steepening the curve. Sorry, there was just a power cut. Can you guys still hear me? Just want to double check. Can you guys still hear me? Can you just confirm if you can hear me? Okay, cool. Thanks, Lisa. Okay, cool. All right. So the idea is here, if the apex is confirmed today, well, then we're going to have a very interesting discussion tomorrow. If we, mind you, if the apex is not confirmed, we're still going to have an interesting conversation tomorrow. But then we can start taking a look at some real potential opportunities. So let's just reiterate. We've got the China market showing potential risk on. Well, that is seriously good news, because it's been the market that's been hammered the most over the last 2 years, right? We've got a very steep, I beg your pardon, a severely inverted 2s, 10s. I think there is going to be a recession, but will the have we got closer to the peak of this particular rate hiking cycle? Now think about it. Let's say there is a recession. There has to be a recession if the Fed is going to drop interest rates. Doesn't that make sense? You drop interest rates when there's a recession. So I think that there is a recession, but I think those 2s come down very quickly. The 2-10s steepens remarkably, and all of a sudden the fund managers go on a huge shopping spree looking for good companies and buying them at bargain prices. So we had a very, very interesting part of the cycle. All right, that's what I had on my list for today. If there's any questions, please go ahead and type those through. Any questions, go ahead and type those through. All right, nothing coming. So let us conclude at this point, and we shall watch. Bear in mind, one last thing, if you're trading, there's going to be very high volatility when that core CPI comes out, headline and core, which is at 3:30 p.m. ZA, 1:30 p.m. UK. So be very, very cautious around that time. All right, guys, let's wrap up here. Have a good day ahead, a good evening, and we shall chat tomorrow. We'll also do the crypto minute tomorrow. Cheers, guys.